Welcome to Tax Notes Talk, a podcast from Tax Notes, the leading source of tax news, information, and analysis.
Welcome to the podcast. I'm David Stewart, Editor-in-Chief of Tax Notes Today International. This week, getting down to business. Alan McLean has long been focused on the impacts of tax policy on businesses. He has managed the tax affairs of Shell for decades, and since 2022 has served as tax chair of business at OECD. As head of the tax committee, he has faced challenges and changes for the international business community, such as the OECD's 2 pillars and the implementation of country-by-country reporting. He recently spoke with Tax Notes chief correspondent Stephanie Sung about his experience and how the committee is handling the evolving world of international tax. Stephanie, welcome back to the podcast.
Thanks so much for having me again.
To begin with, could you remind listeners what Business at OECD is?
Sure. Business at OECD is an advocacy organization that officially represents the interest of the private sector in OECD discussions across all its policy areas, including taxation. It interacts with the OECD in many ways, including through OECD committees and ministerial meetings to advise on policymaking and reflecting the concerns of business. It used to be called the Business and Industry Advisory Committee, or BIAC, and it's still sometimes referred to as BIAC.
So could you tell us what you and Alan talked about?
We talked about what the Business at OECD Tax Committee does, how it operates, what kinds of tax issues it's focusing on, and Alan's priorities as chair. We also touched on some hot button issues, such as the 2-pillar global tax reform plan.
All right, let's go to that interview.
Well, thanks so much again, Alan, for speaking with us today. So just wanted to ask you a few questions about the Business at OECD Tax Committee. I know that a lot of our readers and our listeners are familiar with Business at OECD and the Tax Committee, but I just wanted to get a sense of, what it's like to be on the committee, what it does, how it was created and all that.
Stephanie, and it's always a pleasure and always happy to make time to talk to you and indeed to talk about Business at OECD, because I think, as you say, people are very familiar. Many of your readers and listeners are part of the tax committee of Business at OECD, but I know that for some people it can seem a little bit mysterious, a little bit distant. So always very happy to talk about it and to dispel any myths or misunderstanding about it.
Excellent. Well, let's start off. Tell us just a little bit about how Business at OECD Tax Committee was created.
So shortly after the creation of the OECD itself, Business at OECD used to go under the name of BIAC, and you'll hear those two words interchangeably. BIAC is Business and Industry Advisory Committee to the OECD. So BIAC, Business at OECD, was established in 1962, shortly after the establishment of the OECD. And its purpose really was to be the official institutional business advisory body to the OECD. I think at that point they realized that the work that they were planning to do, the work that they already had in hand, was of global importance to business, also important, of course, to workers and to the labor force. The sort of Business OECD was established at that point and has flourished, I think, since then, and has continued since then to provide input to the OECD across all of its policy areas, not just in tax. But probably it's good to just remind ourselves that the sort of fundamentals or the cornerstones of what Business at OECD stands for are policies that allow businesses of all sizes, and it's not just large business, to contribute to economic growth, sustainable development, and societal development and prosperity. So Business at OECD is a group of national business organizations. So, for example, the US CIB is the US member, and every OECD member state, its national business organization, will be or is a part of Business at OECD and support the activities. That means that we represent over 10 million companies across the OECD countries, and we are able to provide, I think, some of the greatest expertise to help the OECD shape its policy, shape its priorities, and ensure that we have economic prosperity and good global governance. So, as well as those business organizations, all of whom can put forward their candidates to the committee or their representatives to the committee, we also have a number of international sector organizations sort of representing, as you might imagine, banking, insurance, real estate, and so on and so forth. So the tax committee is just one of 30 standing committees that we have in business at OECD. And we have got senior level tax experts, as you know, from business, from tax advisory firms, lawyers, as well as from our own business member organization, those sectoral organizations.
And so how many people are on the committee and how are they chosen? And, along with that, how long is your term as chair of the tax committee?
So we have actually, the tax committee is the largest of all the business OECD committees. And we've got between the business representatives, the advisory firms, the member organization representatives, we've got over 450 experts who all make up the tax committee. Obviously, that's a large number of people to manage. So we also have what we call the bureau. So we have, as well as myself as chair, we have a number of vice chairs. And together we, in the bureau, help to make sure that we prioritize and that we manage the work of the whole committee. In terms of terms for the actual chair and vice chair, there is a fixed term or a maximum term for all of them. I think over recent years, for example, my predecessor, Will, was in place for quite some time. Prior to that, we've seen chairs who've been in place for 2 years, for 5 years, and for longer periods, but there's a maximum term.
I assume you just sort of vote, you have a voting process and all that.
Every now and then, when members come to the end of their term, or they decide to leave for other reasons, then the business OECD central organization will call for nominations. So every business organization that is a member represented on BIAC can put forward any nominations that they wish to. And then the Council of Business at OECD, which sits above the committees, will decide on if there are more nominees than there are vacancies, then they will decide who they think should be appointed to those vacancies. But we are quite flexible in the way that we work. I mean, we have a number of people who are in all but name vice chairs because they play such an active role in the committee, and we rely on them to a great extent.
And what are the committee's main responsibilities and goals, and what have your priorities been since being president?
So the main responsibilities are to provide structured, consensus-based, data-based business input to the OECD across all of its policy areas. Obviously in tax, we've been focused, almost as long as I can remember, a lot on BEPS, on base erosion and profit shifting. But we don't only respond to the things that are coming from the OECD. So we also, from time to time, will go to the OECD and point to areas that we think need more attention. So in recent years, we've lobbied quite hard to have this issue of tax and mobile workforce back on the agenda, or more firmly on the agenda of the OECD. And also we focus quite a lot in our work on the need for tax certainty, which is something which is not always at the forefront of the policymakers' mindsets. So I would say, since I've been chair, we've been focused almost exclusively on BEPS, in particular the two-pillar process for the taxation of the digital economy, largely because that's what the OECD has been focused on. We continue to operate in a whole bunch of other areas, but those have taken up the vast majority of our time and attention.
How does BIAC Business at OECD work with the Trade Union Advisory Committee, TUAC, and how do you envision that relationship to evolve?
So we have BIAC, and then TUAC, as you say, is the other institutional advisory body to the OECD. So we sit side by side as the advisors to the Secretariat and to the OECD countries. We work, I think, we always had a good relationship, good dialogue with TUAC. Of course, from time to time, we may have competing interests, but we actually find that quite often we have similar interests. And, some of those similar interests are making sure that broader perspectives are taken into account when the OECD makes its policy recommendations. So whether those are broader holistic considerations of business impact, or whether they're considerations of the impact on employees or labor, we have that same interest. And I think we also have that same interest in making sure that our voices are heard as early as possible in the process, so that we're not presented with essentially decisions that have already been taken and asked to comment on whether we like them or not. I would like us to work better and more closely with TUAC. And I think that some of the work that we've kicked off, which we've put under a banner of tax and shared growth, that focus a little bit more on some of those areas where tax policy either contributes to for example, inequality. That could be gender inequality, that could be intergenerational inequality on the one hand, or where tax doesn't enable more equal outcomes, more shared outcomes, more sustainable outcomes, we would say. That, as I said earlier, is one of the sort of cornerstones of our approach in business at OECD generally. We want to have policy that is sustainable, and anything that undermines that, we recognize means that the situation we find ourselves is not stable, and therefore will at some point begin to disintegrate, and we prefer to prevent that rather than just to watch that happen.
So it's advised the CTPA, the Center for Tax Policy Administration at the OECD. I mean, how exactly do you work with the CTPA? Do you have regular meetings, or is there like a formal process by which you meet with officials?
We work very closely with the CTPA in many different ways. So if every time we meet, so we have two large meetings a year of our tax committee, historically always face-to-face in Paris. Obviously, since COVID, well, first of all, they weren't face-to-face at all, and now they're more of a hybrid. But we always ensure that during those, we have all of the key Secretariat, CTPA, OECD Secretariat, tax staff attend and engage with us. Normally, we try to make that more of a conversation. Sometimes it takes the form of an update. So that, in a sense, are the sort of a couple of kind of key milestones in the annual calendar. But beyond that, we are constantly in dialogue with teams in the CTPA who are working on whatever it is they happen to be working on at the moment. Of course, that means a lot of involvement with the CTPA on Pillar 1, Pillar 2 guidance and everything that stems from that. So we have decided, because the agenda is so broad, for practical purposes, and also I think just to share the experience and the opportunity to engage with the CTPA, and in the tax committee, we set up a number of working groups. So clearly we have a working group, otherwise known as a BAG, for the pillars, but we also have a working group on tax and environment, tax and development, tax and mobile workforce, and VAT, of course, which is very important to many of our members, and also on tax certainty and the digitization of tax administration, if I can put it that way. So not tax and digital in the sense of the pillars, but tax and digital in the sense of just how we work and how we interact with tax authorities around the world.
Would you say the pillars have been the number one, concern for the tax committee lately? What are people saying?
Yeah, absolutely. I mean, I think it is the thing that, of course, has been a long time coming, a long time in development. We've spoken to many members of Secretariat of the BIAC member state organized tax or policy organization, but also, of course, increasingly to the inclusive framework itself and to the various working parties. So that, of course, has taken a lot longer than anybody had anticipated, and of course continues to take up an enormous amount of effort. So that, I think, our position in BIAC is that we want the two-pillar solution to be implemented. We have, as you will have seen through our public comments on consultation and other statements that we've made, been supportive but also constructively critical about the current versions of the two pillars. We recognize that they're not perfect, but I think we also recognize, more importantly, that there was a sufficient amount of concern about the existing or pre-existing tax framework for international business, particularly in relation to digital and other sort of modern business models, let me call it that something had to be done to restore some balance there. And we look to the two-pillar solution to restore that balance, to provide certainty to businesses so that we can go forward and invest in the way that we need to invest and innovate in the way that we need to innovate with confidence of what the final tax outcome is going to be. So, as I say, warts and all, we have been focused on trying to remove as many of the warts as possible from the two-pillar solution, more than anything, to maintain the momentum and do everything that we possibly can to ensure that there is a successful outcome, not least so we can draw a line under that, move forward with investment, innovation, but also move on to some of these other areas of international tax policy that have probably been a little bit more neglected than they ought to have been.
Just sticking with the two pillars, Pillar 2 is obviously a reality now. Many countries have adopted and implemented and are in the process of adopting the new rules. So I'm sure it's a major concern for your members. What are the main concerns at the moment?
Pillar two, I think it's just the complexity of it. It is the most inordinately complex set of rules that we've ever come across. And the challenges of complying for most of the businesses that are in scope are enormous. We hear anecdotal evidence, and I'm sure you do as well, just quite what the challenges of collecting together the data that are required to fill in the Globe information return. So I would say that the biggest concern is that many large groups who are within the scope of Pillar 2 don't believe that they're going to necessarily have any material tax to pay as a consequence of Pillar 2, but they have the most inordinate compliance burden associated with it. So our focus has been on making sure the rules make sense, but as importantly, making sure that they're as administrable as possible and looking for ways to simplify. So you'll have seen we've put a lot of effort into making the safe harbors as inclusive as they possibly can be, just to minimize that, what we would consider to be unnecessary burden of compliance, which is associated with Pillar 2. If we weren't able to take advantage of those safe harbors. And of course, that's why we're coming forward now with a sort of a position that says, there are undoubtedly areas of uncertainty in the pillars, but rather than focus on trying to gain more administrative guidance, we'd really much rather that the OECD and inclusive framework would focus on working on a permanent safe harbor so that as many companies as possible can minimize their compliance burden associated with very low risk of taxation. And of course, on the other hand, as many country tax administrations as possible can minimize their allocation of resources to areas that are not likely to give rise to any taxes or where there's very low risk of non-compliance.
And to that point, you mentioned a permanent safe harbor, the country by country reporting safe harbor, making that permanent. Tell us more about that and how likely do you think the inclusive framework will accept the proposal?
We're trying to not call it a country by country safe harbor as we go forward, but rather a safe harbor which is based on consolidated financial statements. And I say that not just to be cute about it, but because there is some concern in some parts that the country by country reporting is not as reliable as people had thought it would be. And an enormous focus, and we see that in the Globe information return requirements, an enormous focus on people's sort of almost paranoia that people might seek to get round the rules or to abuse the rules. So we would want something which is, to all intents and purposes, like the CBCR. I mean, it would look very much at high level data. And if you are within that safe harbor, then there's no need to go through the whole compliance. In order for that to be worthwhile, it has to be relatively high level. It may be that the rate may need to be higher than the Globe rate itself, for the 2 rate, but we would at least expect a minimum number of adjustments to be made, and therefore it would be a meaningful and worthwhile safe harbor. If your readers or listeners are interested in that, we've already been quite public on what we think the shape of that might look like. So what do I think the chances of success are? The team in the Secretariat, I think, have been positive. Obviously, it's not for them to promise anything. That's for the inclusive framework itself. But I know also that when we've spoken to many tax authorities around the world, that they would also very much welcome something that would enable them to ensure that they dedicated their resources as much as possible to areas of risk, whether that's Pillar 2 risk or whether that's other areas of risk, and that they don't spend their whole time trying to wade through those mountains and mountains. And I know that's a very physical representation. The tons and tons and tons of data that in the end, for most of us, we believe are not going to actually give rise to any tax liability. So safe harbors are absolutely critical to the sustainable administration, we believe, of Pillar 2.
And is the permanent safe harbor proposal, that's like pretty much the focus? Like, are there any other possible solutions that the tax committee might have in mind, or is most of the focus going to be just on trying to get the permanent safe harbor up and running?
I think we've sort of come to the conclusion that that's the best bet. We've tried as the rules were developed to simplify those. We've tried as the Globe information return was developed to simplify that. We've tried as the administrative guidance has developed to use that as a mechanism for simplification and clarification, but met with some resistance, I think, because of this concern that this isn't, it's enormously complex. It's completely unknown and untested. So I think there's a conservatism in the inclusive framework that would rather that we went overboard than underdid the compliance obligations. So that's not, I don't say that now that the permanent safe harbors are last resort. It's certainly everything that we've got in front of us now has benefited, I think, has been improved from inputs that we've given. But it's now our main area of focus, because we do believe if it can be successful and if it can be implemented, and if we can continue to keep it at the highest level, it will be the most valuable thing that we can have.
And what are your members thinking about the fate of Pillar 1? The OECD has missed the deadline to finalize the multilateral convention for Amount A. What is the feeling in the tax committee about the prospects of that happening?
So I think probably frustration is one of the feelings. I mean, not we have a wide and diverse tax committee, so you can imagine there are a number of different feelings. I think frustration, because an enormous amount of work has been done by the tax committee, by the BIAC, by the secretariat, by the inclusive framework members to try to design something that deals with the perceived problem or the actual problem, depending on what you want, how you want to characterize that. And it's, I think, more or less in the bag. I mean, you will have seen in the last draft, there were a couple of areas that needed to be resolved. My understanding now is that the thing which is holding it up is a desire on the part of one or two countries to have a more robust Amount B. That, I think, would be unfortunate if that were to lead to the non-implementation of Amount A and Pillar 1, given how much effort's been put into it, and given how much it is part of a two-pillar solution that we've all agreed will restore stability and predictability and certainty to the tax regime. So without that pillar, it will be a little bit wobbly, and we would, I imagine, foresee that some other recommendation would come forward that may be better, may be worse. I'm very much in the camp of better the devil you know, even if it's far from perfect. At least it's understandable, and it has benefited from an enormous amount of input from businesses through the airbag process, but also separately in its creation.
So are businesses keeping an eye on the UN developments? How concerned is the tax committee about these developments at the UN?
Well, strictly speaking, the tax committee itself doesn't get concerned about the UN because our focus in business at OECD is almost entirely on the work of the OECD. As you know, the ICC is the sort of the equivalent institutional advisor, stakeholder in the UN processes, and we look to the tax committee of the ICC to make representations. That said, obviously, we have a whole number of our tax committee members who are also members of the ICC tax commission and committees. So we have an enormous amount of overlap and clearly an enormous amount of interest in making sure that the two organizations work together as well as possible. So I think my main concern and probably the main concern of our members at the moment is that UN work is quite onerous. There's a lot of work to be done there. It's quite ambitious in some areas, and that puts a lot of pressure on tax policymakers from some of the countries who are also members of the inclusive framework. So one of our concerns is that they get distracted from finalizing the work of the inclusive framework on BEPS because they're busy trying to do the work on the UN framework in terms of reference. Now there's greater clarity there. That may help to simplify things. So that would be on the one hand. It's just that there is limited bandwidth to deal with all of this international tax work which is underway. We leave the ICC tax people to provide the direct input, but together we're committed to making sure that as far as possible, we don't see divergence between standards in the UN and the OECD. And that to the extent that the UN issues new instruments, that they should, as far as possible, be complementary and work together with the instruments of the OECD, which, of course, have had a very important status, since their inception, and there are other instruments, whether that's the Model Convention Tax Treaty or whether it's the transfer pricing guidelines. They've had the sort of gold status really for quite some time. So anything that would undermine that would create uncertainty over which standard might apply in a particular transaction or a particular country or a particular set of circumstances, just creates more uncertainty. And to kind of come back to where we started, for us, uncertainty damages confidence of business and therefore means that there's less growth, there's less investment, innovation, and ultimately that's not a good thing for the global economy.
You mentioned the bandwidth issue. How do you balance all of this business at OECD tax committee responsibilities, feedback, and your day job? I mean, it sounds like a lot to handle for for everyone involved.
Well, it is, and I think that brings us almost to one of the great strengths of the tax committee is that we share the work and we have the access to the deepest expertise and the widest range of views, and people can participate as much as they want, as much as they're able, and I think that way across our 450 plus members, we're able to make sure that we manage all the work. I would say that since we've had these various working groups look, more dedicated to particular aspects, that's certainly helped me, and I think helped the committee as a whole to make sure that we mobilize as well as we can, that we make the most of these enormous resources and highest quality resources that we have available to us in the tax committee.
And so beyond the pillars, what other issues would you say are going to be the highest priority for the tax committee? And, what do you hope to accomplish when your term is up?
Well, a number, I've mentioned some of them already, are the areas that we think will continue to take the place, if I can put it that way, of the work on the pillars once that's finally concluded. So tax and the mobile workforce, and we use that name as a sort of umbrella for handling the various challenges that arise as a result of changing business models, changing employment models, and so on and so forth. So we're particularly concerned about the way that modern business is done and how that works together with, for example, relatively static perspectives on permanent establishments, for example. So there's a big work stream, I think, that we need to turn our attention to on tax and mobile workforce. The challenge there is just making sure that we focused on the highest priorities first. Tax and development, that goes a little bit hand in hand with some of the considerations that we discussed there on the UN. I mean, clearly the inclusive framework is a large body of countries. Many of them get technical assistance from the OECD and from other organizations to ensure that they understand and they can apply things like the OECD instruments. We in Business at OECD, as much as possible, want to support that, want to make sure that we can work together with OECD, for example, and educate, and that way ensure that some of these developing economies understand the value of the instruments and are able to operate them effectively. That covers even things like withholding taxes and the administration of those, which sometimes might seem like relatively small beer, but often for some of our members are significant amounts of money. Then we have tax and digital, as I said. Most tax authorities are looking at how to digitize their own operations in order to be as efficient from a resource perspective as possible. So we have the Forum of Tax Administration, which is a body which operates under the OECD, that is keen to ensure that work is done together, so that we don't have a whole raft of different formats that we might need to comply with. So we are also then providing a lot of input already into the development of that work, and it goes under the heading of Tax Administration 3.0, which is a sort of seamless tax administration ambition, which is much to be admired. Obviously, we continue to work on VAT, and that's an area where we've always worked very closely and very successfully with the OECD, because it's very transactional, and getting that stuff right in the detail is really important. The environment, climate change, a lot of focus in the OECD on tax and the environment. We have an inclusive forum on carbon mitigation approaches, which is not only tax work. It looks much more broadly at a number of different things, but ultimately we think that some of the policy instruments that will help ensure that carbon is managed as effectively as possible will be tax instruments, and that is work that we're therefore keeping an eye on. OECD is also very interested in corporate tax measures taken to try to incentivize work to mitigate the impacts of climate change, for example. So we're working on that. And then I think finally some of the work which I mentioned earlier about tax certainty, including some of the tax dispute prevention and resolution mechanisms, so trying to improve ICAP, the International Compliance Assurance Program, trying to improve MAP, mutual agreement procedures, and everything which is associated with providing greater certainty for taxpayers and tax authorities alike. In terms of what would I like to have achieved? I mean, certainly I would like to have been able to say that we delivered and we did our best to deliver Pillar 1 and Pillar 2 that were as good as they could be in the circumstances by the time I come to the end of my term. But I think also then just having established, these working groups that would work effectively and engage early with the OECD, with the Secretariat, with the working parties, and with the inclusive framework as a whole. If the inclusive framework will continue, as I expect it will, in some form or another, continue to exist post the finalization of the sort of policy work associated with BEPS. And that's where, as I said, I come back to, this sounds like it's about the chair, the work of all of the members of the committee, particularly the vice chairs who lead these working groups and who participate on the business advisory groups, etc., is enormous. And I would hope that I can hand that over in as healthy a form to my successor as my predecessor did to me.
Well, Alan, thanks so much for being on the podcast.
Thank you very much indeed. It's been a pleasure.
And now, coming attractions. Each week we highlight new and interesting commentary in our magazines. Joining me now is Acquisitions and Engagement Editor-in-Chief Paige Jones. Paige, what will you have for us?
Thanks, Dave. In Tax Notes Federal, Duran Naratsky and Vered Naratsky argue that reducing the federal corporate tax rate to 15% would be a mistake. Harrison Richards reviews the rules concerning the deduction of expenses for corporate air travel and the use of private jets. In Tax Note State, Elise McLaughlin and Kathleen Quinn examine the silver lining in the Moore decision. 3 McDermott, Will, and Emery practitioners examine transfer pricing audit practices. In Tax Notes International, Anshu Khanna reviews India's Union Budget 2024. Dan Roman explains why fears surrounding the UK qualifying asset holding company regime under a Labour government are unfounded. And finally, in Featured Analysis, Nana Amasarfo discusses a new French tax offense for individuals and firms that facilitate tax fraud.
That's it for this week. You can follow me online at TaxStew, that's STEW, and be sure to follow at Tax Notes for all things tax. If you have any comments, questions, or suggestions for a future episode, you can email us at podcast@taxanalyst.org. And as always, if you like what we're doing here, please leave a rating or review wherever you download this podcast. We'll be back next week with another episode of Tax Notes Talk.
Tax Notes Talk is a production of Tax Notes. You can learn more about us by visiting www.taxnotes.com/podcast. When major media wants the straight story, they turn to Tax Notes. Thank you for listening, and join us again for another edition of Tax Notes Talk.
Want more like this? Subscribe for more tax videos. Special thanks to our executive producers Jasper Smith and Paige Jones, showrunner and audio engineer Jordan Parrish, and audio engineer Peyton Rhodes.